So Lowe's is currently trading right around $215.97 today,
Right.
which, if you've been following the market, you know is a brutal 26% drop from their 52-week high of roughly $293 back in February.
Yeah, it's a confirmed downtrend,
Yeah.
and they're barely hovering above their 52-week low of 199.
Exactly. And the massive paradox here, the main catalyst we're unpacking today, is that in their Q1 fiscal 2026 report, they actually beat Wall Street's revenue and earnings estimates.
Right. They brought in $23.08 billion.
Yeah. They crossed the finish line first, but the market is just, absolutely punishing them. And today, we are going to figure out why.
It's a classic market reaction, honestly.
Oh, for sure. But before we get into the weeds of the margin compression and the housing market freeze, welcome to Market Pulse Daily. I'm your host, and as always, I'm joined by our resident market expert.
Great to be here. There is a lot to unpack with this one.
There really is. And just a quick heads up for you listening, today's analysis is brought to you by StockOracle.
Yeah, if you are looking to dig into the fundamentals yourself, StockOracle is this incredible AI-aided stock research platform.
It really is. You can use it for, valuation estimates, moat analysis, getting bull and bear insights, running comparisons, or just managing your watch lists and portfolio research.
Exactly. But we do need to make it super clear that StockOracle is not financial advice.
Right. It is not a buy or sell recommendation. It's not a trading signal service, and it doesn't provide real-time market data.
Yeah, and AI insights and valuation estimates can be incomplete or just wrong, and the data might be delayed. So always verify important facts yourself.
100%. We've got a special 14-day trial link for StockOracle down below in the description. Just click that to check it out. And full transparency, it is an affiliate link, so the channel may earn a commission at no extra cost to you.
Which helps us keep the show going.
Exactly. All right, so let's get back to Lowe's. Like we said, they beat the Q1 estimates, $23.08 billion in revenue. Adjusted EPS hit $3.03.
Yeah.
But major analysts from Bank of America to Wells Fargo are universally slashing their price targets.
Yeah.
Why?
Well, because to understand the panic on Wall Street, you have to look completely past those shiny headline numbers.
Okay.
You have to pop the hood on how they actually generated that $23 billion. We have to look at the underlying organic demand.
Right.
And when we strip away the noise, the picture underneath is incredibly tepid.
I mean, I have to admit, I'm a bit confused there because the data shows they grew top-line revenue by 10.3%.
Right.
In retail, a 10% jump doesn't sound tepid. It sounds like a massive victory.
It sounds like a victory until you dissect where that 10.3% actually came from.
Okay.
Because it didn't come from everyday shoppers walking in to buy more hammers and paint and, patio furniture.
Yeah.
The organic growth in the actual stores was basically non-existent.
Wait, then where did the extra billions of dollars come from?
Two main sources. First, we saw some pretty significant price hikes and a slight bump in professional demand, which artificially drove the comparable ticket size up by 1.5%.
Oh, so people weren't buying more items, the items just cost more.
Exactly. But the real heavy lifter here, the engine behind that revenue beat, was massive corporate acquisitions.
Oh, right.
Lowe's went out and bought two companies, FBM and ADG.
Right, the commercial distributors.
Yeah, they specialize in professional commercial distribution. So the revenue from those acquisitions was just lumped into the overall Q1 numbers, which, completely masked the weakness in the core business.
So they essentially just went out and bought their revenue growth to make the quarter look good.
Yeah, pretty much. And the data proves it. If you strip away those two acquisitions and the inflated pricing and you look purely at the transaction volume, meaning the actual number of times a cashier rang up a customer transactions actually fell by 0.9%. Yeah, the everyday do-it-yourself or DIY customer is feeling immense economic pressure right now. They simply aren't showing up in the aisles the way they used to.
But I still want to push back on this Wall Street reaction.
Sure.
Even if they bought the revenue through acquisitions, revenue is still revenue, right? It's cash coming into the ecosystem. So why would RBC Capital lower their price target to 231? Why would Wells Fargo aggressively cut theirs from 255 down to 245?
Right.
Even Mizuho and Telsey Advisory Group cut their targets.
Yeah.
If Lowe's is bringing in more money, why the universal punishment?
Because Wall Street knows that bringing in revenue is completely useless if it costs you too much to generate it.
Ah,
The panic isn't about revenue, it is entirely about profitability. And that introduces us to the true cost of buying those acquisitions, which is severe margin compression.
margin compression. I've always heard that referred to as like the silent killer of stock prices.
Oh, it is the single fastest way to destroy shareholder value. In Q1, Lowe's adjusted operating margin dropped to 11.5%. That's down 40 basis points year over year.
And just to clarify for anyone unfamiliar, a basis point is just 1/100th of 1%.
Exactly. It sounds small, but when you are dealing with $23 billion in a single quarter, 40 basis points represents a massive amount of vanishing profit.
Yeah, that adds up fast.
And it gets worse. Their EBITDA margins, which measures earnings before interest, taxes, depreciation, and amortization, that compressed from 14.1% a year ago down to 13.9%.
So the translation here is that Lowe's is technically making more money overall, but they are keeping significantly less of it for every single dollar they earn.
Yes, and the research reports we are analyzing explicitly attribute this drop in profitability not just to a weak consumer, but directly to those new acquisitions, FBM and ADG.
Let me make sure I'm fully grasping the mechanics of this because the scale is just wild.
Oh.
According to the data, these acquisitions are expected to add an incredible $8 billion to Lowe's top-line revenue for fiscal 2026.
Right.
That's roughly 9% of their total revenue. But those acquisitions are B2B, business-to-business professional distribution models. Are you saying they're dragging down the whole companies simply because of how they operate?
Exactly. You have to look at the structural difference between selling to a DIY homeowner versus a pro contractor.
Okay.
When a weekend warrior walks in to buy a gallon of premium paint, Lowe's charges a high retail markup. The profit margin on that single transaction is very thick.
Right, they're paying top dollar.
Yeah. But FBM and ADG are selling massive bulk quantities of drywall, lumber, commercial building supplies to professional contractors.
And they want discounts.
Oh, they demand volume discounts, relationship pricing, expensive delivery logistics. The revenue numbers are huge, but the actual profit squeeze out of each sale is razor thin.
Okay, so the core business has thick margins, the new businesses have thin margins, and by mixing them together, the overall company average just drops.
It drops so much that their gross margin is expected to see a 75 basis point drag in fiscal 2026 purely from this mix shift.
Wow.
Management is trying desperately to offset it by finding about $1 billion in productivity gains internally, but, the dilution is unavoidable.
Which naturally brings up a major strategic question.
Yeah.
Why would a mature, highly successful company intentionally sacrifice its own profit margins to buy these specific low-margin companies right now? It feels incredibly counterintuitive. Is it desperation?
It's less about desperation and more about a brutal strategic reality.
Okay.
It's the ultimate innovator's dilemma in the retail space. Lowe's is basically being forced to cannibalize its own profitability today just to buy a seat at the table for tomorrow.
Oh, I see where this is going.
Yeah. It all stems from their endless existential rivalry with the Home Depot.
The classic orange versus blue turf war.
Exactly. And the stakes have never been higher. I mean, Morningstar still gives Lowe's a wide moat rating, recognizing their massive structural advantages and brand power.
Right.
But Lowe's has a glaring vulnerability, and the entire retail sector knows it. Home Depot utterly dominates them when it comes to the pro customer.
We're talking about the heavy hitters, the independent contractors, the home builders, the plumbers.
The people who drive up in a flatbed truck on a Tuesday morning and spend $5,000 on raw materials every single week of the year.
Yeah.
Lowe's traditional stronghold has always been the DIY customer, the person remodeling their own guest bathroom on a Saturday afternoon.
Right. But right now, in August 2026, DIY spending is arguably the absolute weakest segment in the entire global retail market.
Exactly. So imagine you own a high-end steakhouse. You make incredible margins on those steaks, but suddenly the economy shifts and your main dining room is just empty.
Nobody is walking through the front door.
Right. But you still have rent to pay. So to keep cash flowing, you go out and buy a massive corporate catering business.
Ah, okay. Yes, it brings in top-line revenue, but running a catering fleet with delivery trucks and low-bid contracts is a completely different, much lower margin business model than serving high-priced steaks. That analogy perfectly illustrates it. They bought the catering business because the dining room is empty.
Exactly. They know the pro market is the only segment showing any signs of life. But what is truly fascinating here and terrifying for investors is the sheer risk profile of this pivot.
How so? I mean, a sale is a sale, even if the margin is lower, right?
Not all sales carried the same macroeconomic risk. By acquiring FBM, Lowe's didn't just buy revenue, they bought exposure. Roughly 50% of FBM sales come from large-scale commercial activity.
Wait.
Specifically, new home construction.
Oh, wow. So in their desperate attempt to catch up to Home Depot, Lowe's has heavily tied its own fate to the new home construction market.
At the exact moment that the new home construction market is facing a generational crisis. By chasing the pro market through these acquisitions, they just tethered their life raft to an absolute anchor. Because right now, the broader housing market is completely frozen.
And that context is crucial. Lowe's does not exist in a vacuum.
Yeah.
Every 2x4 they sell is tethered to the macroeconomic environment. And stagnation doesn't even begin to cover what is happening in housing right now.
It is paralyzed. And it is largely being stifled by one single suffocating metric, which is mortgage rates sitting stubbornly above 6%.
Yeah. Think about your own situation for a second. If you own a home, there's very high probability you locked in a mortgage rate a few years ago at something like 3 or 4%.
Right.
If rates today are hovering over 6%, are you really going to sell your house, give up that incredibly cheap monthly payment, and buy a new house at double the interest rate?
Absolutely not. You're staying exactly where you are.
Exactly.
Economists call it the lock-in effect, the golden handcuffs of low interest rates. People literally cannot afford to move.
And historically, the biggest catalyst for big-ticket home renovations, the massive projects that generate Lowe's biggest profits, is when people buy a new house and want to fix it up, or when they are prepping to sell.
The mechanism is simple. If nobody is moving, nobody is doing major, expensive remodels.
Right. They might buy a light bulb, but they aren't gutting a kitchen.
Exactly. And we are seeing this exact same mechanism play out across the entire retail landscape. Look at the data from Tractor Supply.
Oh, yeah?
They recently had to cut their full-year 2026 outlook, specifically citing a severe weakening in consumer demand. They are acting as the canary in the coal mine for all discretionary spending.
Discretionary spending, the nice-to-have purchases, the upgraded patio set, it's completely drying up. The consumer is just tapped out by inflation and high borrowing costs.
Yeah.
But I have to ask the difficult question here.
Sure.
How much of this 26% stock decline is actually the fault of Lowe's management? Are they making bad operational decisions? Or is this just the harsh reality of the Federal Reserve keeping interest rates artificially high?
It is overwhelmingly the latter. But, the stock market does not give out participation trophies for trying hard in a bad economy.
Fair point.
We have to remember how markets function. They are forward-looking pricing mechanisms. That 26% drop from their February high isn't a delayed reaction to a mediocre Q1.
Right, they beat Q1.
Exactly. It is the market actively pricing in a prolonged, agonizing housing downturn. The algorithms and institutional investors are calculating that the pain is going to last well into next year.
I mean, look at Lowe's own internal projections. Management is officially expecting that overall industry demand for 2026 is going to be somewhere between down 1% and up 1%.
They're essentially projecting a total flatline.
Yeah.
And when an entire industry is flatlining, the market punishes the stock in advance. It's not necessarily that management is failing, it's that the water level of the entire ocean they sail in is dropping.
Yeah.
You can be the best captain in the world, but if the lake dries up, your boat is going to hit the mud.
Here is where it gets really interesting, though. Because if the market is forward-looking, that means at a certain point, all of this terrible macroeconomic news is already baked into the current stock price.
Yes.
The panic has already been priced in, which forces us to stop looking backward and start looking at what comes next.
And what comes next is arguably the most critical date on their calendar this year, which is August 19th, 2026, their Q2 earnings report.
This is the ultimate scheduled catalyst. When they report those numbers, investors aren't just going to be satisfied with another manufactured revenue beat.
No, absolutely not.
They're going to demand hard, undeniable proof that the bleeding in the DIY segment has stopped, and more importantly, that these massive margin-diluting pro acquisitions are actually generating cross-selling synergies.
They need to prove to Wall Street that buying the catering business is actually funneling new, profitable customers back into the dining room.
So with the stock sitting around $215, we have to look objectively at the pros and cons here. Is Lowe's a value trap, or is it a genuine bargain right now? Let's explore the bull case first.
The bull case is incredibly compelling if you are an investor willing to look past the immediate macroeconomic gloom.
Okay, lay it out for us.
At around 215, the stock is trading at a 17.7 forward price-to-earnings ratio. For a company of this immense scale in a duopoly with Home Depot, that is generally considered quite reasonable.
Right.
Furthermore, Morningstar places Lowe's fair value estimate at $250.
So it is currently trading about 14% below what one of the most respected research firms thinks it's intrinsically worth.
Exactly. And you cannot ignore their underlying financial health. They hold a highly coveted investment-grade BBB plus credit rating, which gives them cheap access to debt if they need it. They have robust billions of dollars a year cash flow generation. And for dividend investors, Lowe's is a fortress. They boast a 10-year dividend compound annual growth rate of 16%.
16% annualized dividend growth over a decade is, that's the kind of consistency income investors dream about.
It really is.
But as I was reviewing the data, there was one financial quirk that jumped out, and I need you to explain it.
Okay.
Their price-to-book ratio is listed as 275.45, which reflects a significant negative book value. Now, for someone casually glancing at a balance sheet, negative book value sounds like the company owes more than it owns.
Yeah, it does.
Sounds like they are insolvent. Are they secretly going bankrupt?
It sounds absolutely terrifying, but in this specific context, it is actually a byproduct of aggressive financial engineering.
Oh, really?
Yeah, we need to break down how book value works. Essentially, book value is a company's total assets minus its total liabilities. That leaves you with shareholders' equity.
Okay, simple enough.
Over the last decade, Lowe's has used its massive cash flows to buy back its own stock on the open market. When a company uses cash to buy back stock at prices far above its historical cost and then retires those shares, it shrinks the equity on the balance sheet.
Right.
So if they do it aggressively enough for long enough, equity can actually be pushed into negative territory on paper.
Okay, so they aren't insolvent. They've just spent so much cash buying their own stock that the accounting math looks weird.
Exactly. It's not unusual for mature, cash-rich companies like Home Depot or Starbucks to have negative book equity. It is a highly efficient way to return value to shareholders, though it does technically limit their balance sheet flexibility if a severe crisis hits.
Okay, that makes sense. But I have another pushback, and it has to do with market sentiment.
Let's hear it.
The data points out that insider sentiment is supposedly positive right now. But when you look at the raw transactions over the last 90 days, insiders have actually sold about 11,000 more shares than they've bought.
Right.
We see 16 individual buy transactions and only 5 sell transactions. But the net volume is massively negative. How can sentiment be positive if the net volume is negative? Shouldn't that make us very nervous?
That is a brilliant observation, and it highlights exactly how tricky it can be to interpret insider data. You have 16 different individuals inside the company buying shares.
Which sounds good.
It indicates broad, widespread positive sentiment among the mid to upper management team. They think the stock is cheap, but those 5 people who sold, they didn't just sell a few shares, they sold in massive bulk.
They just dumped their holdings.
They moved serious volume, likely executives exercising massive option grants. So the net dollar-weighted flow is heavily negative even though more individuals are buying.
Wow, okay.
I would advise intense caution here. Broadly, the team thinks it's a good time to buy, but the few individuals with the absolute largest holdings are quietly taking a lot of chips off the table.
And when you add in the fact that implied volatility in Lowe's stock options is currently surging, it paints a picture of a market that is highly anxious. Implied volatility is essentially the cost of insurance on a stock, right?
Well, that is exactly how to think about it. Think of options premiums like hurricane insurance in Florida. In December, when the skies are clear, insurance is incredibly cheap.
Right.
But when a Category 5 hurricane is sitting right off the coast, in this case, the highly uncertain August 19th earnings report, the cost of that insurance skyrockets.
Yeah, that makes perfect sense.
Traders are paying massive premiums right now to protect themselves against a violent, unpredictable swing in Lowe's stock price. No institutional investor is sitting comfortably on the fence.
So what does this all mean? Let's synthesize the moving parts for our final outlook. From everything we've unpacked today, Lowe's is fundamentally an exceptionally well-run business.
Without a doubt.
Let's not forget, despite all these macroeconomic headwinds, management has delivered 4 consecutive quarters of positive comparable sales. They have driven $1 billion in internal productivity gains to offset those painful acquisition costs. They even made the difficult decision back in February to cut 600 corporate and support roles.
Which, just to add context, was less than 1% of their workforce.
Exactly. Just to ensure they were focusing every available dollar on the frontline store employees.
They are doing precisely what an elite management team is supposed to do during a deep cyclical downturn. They are tightening the belt, optimizing operations, and trying to secure future growth.
But they are completely trapped.
Yeah.
They are caught in a vice grip between two massive opposing forces. On one side, you have the Federal Reserve holding mortgage rates high, which has locked the housing market down and absolutely killed Lowe's highly profitable DIY demand.
Right.
And on the other side, you have the existential necessity of buying margin-diluting commercial distribution companies just so they don't get permanently left behind by Home Depot in the pro space.
And that is the ultimate takeaway to remember, the real key risk here. A stock's price, especially in a sector as sensitive as retail, often reflects macroeconomic forces just as much, if not significantly more, than a company's actual operational skill.
The CEO can execute the playbook perfectly, but if the Fed keeps mortgage rates above 6%, the stock is going to struggle to find air.
Exactly. You need to watch that upcoming August 19th earnings report closely. It will be the defining test to see which force ultimately wins out: management's operational discipline or the crushing, undeniable weight of the frozen housing market.
It really makes you wonder about the broader landscape of the entire retail sector right now. If a mature, incredibly well-resourced giant like Lowe's has to rely on cutting corporate jobs and buying up lower-margin commercial competitors just to keep its head above water during a housing freeze, are we entering an era where organic growth in major retail is essentially dead until mortgage rates drop?
It's a huge question. If the dining room stays empty for another year, how many catering businesses can these retail giants really afford to buy before their profit margins just evaporate completely?
Definitely something to think about as we head toward that earnings date. All right, that wraps up today's analysis. Don't forget to hit that subscribe button so you never miss an episode of Market Pulse Daily.
And remember to check out that 14-day trial for StockOracle in the description below if you want to run these kinds of valuation estimates and mode analyses for your own watch list.
Exactly. It's an amazing AI tool for your portfolio research. Just keep in mind the data can be delayed. It's not financial advice, and you always need to verify the facts yourself.
See y'all next time.
Until next time.